If you are waiting for rates to drop before you buy, we need to talk. If you're sitting on the sidelines waiting for mortgage rates to finally drop before you buy a home, I want to ask you a question. What if they don't? What if rates stayed exactly where they are today for the rest of this year? What's your plan? And I don't ask that to scare you. I ask because I think a lot of people have put their lives on hold waiting for a headline, and I don't know that enough people are asking themselves that question. Because over the last few weeks, we've gotten new inflation data, new job numbers, and more signals from the Fed. And instead of bringing us closer to the rate cuts everyone has been hoping for, they've pushed that timeline further out. So today I want to break down what's actually driving mortgage rates right now, what the Fed does and does not control, what does the latest inflation and job reports mean, and most importantly, what this means for you if you are thinking about buying or selling a home. Because here's what I keep seeing. People are so focused on the rate itself that they are missing the bigger picture. And that's exactly what we're going to talk about today. Now, if you find value in videos like this, I would love for you to hit that thumbs up and subscribe to the channel. And if you have a question about buying or selling, drop it in the comments. I read them personally and I do my best to answer as many as I can. So let's get into it. So what actually is moving mortgage rates right now? Honestly, one word, and it's uncertainty. That's really what it comes down to. We still have conflict happening overseas that's keeping energy prices on edge. Inflation hasn't completely cooled off, and the Federal Reserve has been sending mixed messages. And if there's one thing financial markets hate, it's uncertainty. Coming into this year, many people thought we would see 2 or maybe even 3 rate cuts. Now, a lot of those expectations have been pushed much further out. Even when markets don't have clarity, they price in risk. That's called a risk premium. And that risk premium is a big reason why mortgage rates have stayed elevated instead of falling the way many people expected. And here's something I really want you to understand. Mortgage rates do not move in a straight line. They're volatile. Earlier this year, rates dipped below 6%. Then in a relatively short amount of time, they pushed back towards 6.75. And it doesn't take much. One headline, one comment from the Fed, one unexpected economic report, and rates move. So if you're trying to perfectly time the bottom, just understand what you're trying to time. You are trying to predict headlines you do not control. Now, let's talk about the Fed for a minute because I hear people say all the time, I'm just waiting for the Fed to lower rates. The first thing you need to know is this: the Fed does not directly set mortgage rates. They set the Fed funds rate, which is a short-term interest rate. Mortgage rates tend to follow the bond market, especially the 10-year treasury, but the Fed still matters because the Fed reacts to inflation, and inflation is really the entire story right now. At their recent meetings, the Fed has essentially done nothing. They've held rates steady, and that actually tells us a lot because the reality is even the Fed cannot agree with itself right now. Some members believe rates should come down, others think inflation is still too much of a concern, and when there's disagreement, the Fed usually waits, which is exactly where we are today. If you've watched some of my past videos, you probably heard me say this before. The Fed wants clarity. They want to know where inflation is headed. They want to know what employment is doing. And right now, there's just a lot of uncertainty. So why is the Fed stuck? Inflation. Let's go back a few months. Inflation was improving. We were moving in the right direction. The job market was healthy. Those are exactly the conditions that typically help mortgage rates move lower. But then things shifted. Energy prices moved higher, and energy impacts everything. Transportation, manufacturing, shipping. When businesses pay more, consumers eventually pay more too. The latest inflation reports reflected that. Inflation has not gone away. It's become sticky, and in some areas, it started creeping back up again. Here's something else people don't always realize. The inflation number you hear on the news is not even the Fed's favorite measure. The Fed pays very close attention to something called PCE, and that number has not been moving in the direction they want either, which means cutting rates becomes a lot harder. Now, let's talk about the jobs report, because this part is really important. For the last couple of years, everyone has been watching the labor market. The Fed's biggest concern was that employment would weaken enough to force rate cuts, but that's not what we're seeing right now. The latest job report surprised people. Job growth came in much stronger than expected. Unemployment remained relatively stable and wages continued growing. In other words, the labor market is not breaking. And that matters because a weak labor market would have likely pushed the Fed towards cutting rates sooner. Without that pressure, inflation becomes the priority again, which is exactly why strong jobs data actually pushed rates higher. The one thing that would have forced the Fed's hand simply isn't showing up. So where do I think rates are headed? Honestly, probably sideways. And I know that's not what you wanted to hear. I think we could continue living in this range for a while. Not dramatically lower, not dramatically higher, just bouncing somewhere in the middle. And I know that's probably not the exciting answer everyone wants, but that's what the data is suggesting right now. And here's something I've noticed with my own clients. There's almost this invisible line in the sand. When rates get closer to the low sixes, buyers feel more confident. When rates push higher, people hesitate. They pause, they wait. Demand changes quickly. I've watched it happen in real time. And that's why I say today's market is incredibly rate sensitive. Now, here's where I think a lot of confusion comes from. People talk about the housing market like it's one thing, but it's not. There are really three different housing markets happening right now. The first is the strong seller's market. These are markets with low inventory and high demand. Homes are still receiving multiple offers. Some are still selling above asking price. We even see that in pockets here in Colorado. If a home is beautifully updated, priced correctly, and in a desirable neighborhood, it is often still very competitive. Then you have true buyer's markets. Markets where inventory has built up, where buyers have negotiating power, where people are negotiating seller concessions and price reductions. Those markets exist too. And then you have what I think most of the country falls into, the middle market. Prices are not crashing, but they're not skyrocketing either. They're moving sideways. That's why headlines are so confusing. One person reads that prices are rising, someone else reads they're falling. Both can be true depending on where they live. Real estate has always been local, and right now that could not be further from the truth. One thing that surprised me this year is inventory. I thought we would see a much bigger increase, but uncertainty has caused many homeowners to stay put. Millions of people have mortgage rates in the 2%, 3%, and 4% range. They don't want to give those up. So buyers are waiting, sellers are waiting, inventory stays tight, and the cycle feeds itself, which brings me to the biggest mistake I see buyers making right now. They're waiting for three things to happen at the same time. They want lower rates, lower prices, and more inventory. But the problem is those things rarely happen together, because when rates finally come down, buyers come back, competition increases, and prices often move up. You're not the only person watching mortgage rates. I also want to address something you hear all the time: date the rate and marry the house. And honestly, I've never loved that phrase, because I don't want anyone buying a home they cannot comfortably afford today based on the hope of refinancing tomorrow. If rates drop later and refinancing makes sense, wonderful, that's a bonus. But I want you to be comfortable with the payment right now. I want you to have money left in the bank. I want you sleeping at night, not crossing your fingers waiting for a future rate cut. So instead of obsessing over daily mortgage rates, focus on what you actually can control, your timeline. If you're planning to stay in the home 5, 7, or 10 years, short-term rate fluctuations matter less than you think. Your payment matters. Can you comfortably afford the home today? And your local market. Are you in a seller's market, a buyer's market, or somewhere in between? Because your strategy changes depending on where you are. So let's go back to where we started. Are rates going to drop? Maybe. If inflation improves. If energy prices stabilize. If the data shifts. But based on what we're seeing today, that timeline appears to be moving further out. And it's honestly made me rethink how quickly I expected rates to come down. But here's what I don't want you to miss. A market with rates in the sixes is not a bad market. It's just a different market. And there can still be incredible opportunities if you understand your numbers, know your local market, and build a strategy around your actual goals instead of waiting for the perfect headline. So I'd love to hear from you. Are you waiting for rates to come down before you buy? Are you moving forward with the rates we have today? Let me know in the comments and tell me, where are you located? Is your market competitive? Are you seeing price reductions? Are homes still moving quickly? I always love hearing what's happening across the country. And if you found this helpful, don't forget to like and subscribe. And if you need help building a strategy that makes sense for your situation, whether that's connecting with a great lender or a real estate agent in your area, there's a link below. Don't hesitate to click it. I connect within 24 hours, and I'd be happy to connect you with someone who approaches real estate the same way I do. At the end of the day, don't build your future around headlines. Build it around a plan that works for you. If you found this video helpful, make sure to subscribe.